To start us off today, we are very happy to have with us Matteo Maggiori from Stanford University to give introductory remarks on this topic and set the stage. So Matteo, I'm going to turn it over to you now. You have 15 minutes.
Thank you, Lars. It's a great pleasure to be here and welcome everybody. I was asked to give introductory remarks on this topic, which is really a pleasure because there's been a ton of research over the last 10 years. It also turned out that I was asked to write a handbook chapter about something quite related for this week. So I had sort of spent some time thinking about the literature. I think it's fair to say that over the last 15 years, let me just switch to this. Over the last 15 years, there have been very severe crises with large policy interventions in financial markets. And QE, FX intervention, and it became more obvious to everybody that the question of who owns which assets, it's an important one, not just at the micro level, but also at the macro level. And that has led to a big wave of theoretical work trying to incorporate financial market imperfections into general equilibrium frameworks, both in closed economy and in open economy. And it's really also opened up the idea that we really want to know who owns which of the assets. And that one, I think it's still ongoing, probably more so than theory. There's a big effort, which I will try to highlight across academia, policy institutions, trying to collect data on capital allocations, how firms and governments match with investors in these markets. What I'll try to do today is very briefly take stock of what has been done, really very briefly, and then speculate a little bit about what's missing, what are we not doing well, where might we go next, which of course are just more on my own musings. Where do we come from at a very broad level? Well, it's fair to say that international macro has always paid a lot more attention to frictions than perhaps domestic macro did. Part of that is international markets are just by their own nature more segmented. There are more frictions. There is default. There is expropriation. Also the literature paid more attention to emerging markets that always had large crises. So there was a continuum of this over time, but over the last 15 years, it has certainly accelerated a lot. If I try to go deep back in time, I think a lot of us find the NERC's view of capital flows generating destabilizing movements in exchange rates has really shaped a lot of the intellectual capital in the field, as opposed to, for example, to Friedman, stabilizing speculation. A lot of the recent literature, including my own work, has really gone back to the work of Penticuri in the 70s, the portfolio balance approach to exchange rates, where currencies are imperfect substitutes, and the demand and supply of these assets in different currencies pins down the exchange rate. This was really a key insight that over time had gotten somewhat lost in modern models. Part of that was a lack of foundations. There was a model of the 70s when precise models, particularly from the Chicago school, started to come around. It became clear that making these statements stick in a general equilibrium model is not as straightforward as one would think. You need to put a lot of frictions and segment things appropriately. And it took a little bit of time to sort of figure out how to do this in an easy modern sense. Here's how I think about this kind of models. The traditional model, almost every model has countries. Here I have the US and Japan, and they trade in the goods market with each other. Now, in most macro models, that one is really extremely stylized compared to, for example, trade models, but there's certainly variation. And then generally, we have to decide what assets these two countries trade against each other. They might trade a complete or an incomplete set of assets, depending on the model. Models of sort of segmentation are a little bit different. They bring in a third set of players here, the financiers, and they make the trade in financial assets, here I have bonds, happen against this sort of central party. What are they trying to capture? They're trying to capture the idea that most of the world financial markets, particularly for currencies, are very, very heavily intermediated by some large players. And despite, think of like the investment banks or the large asset management group, and despite the fact that these groups are big, so are the markets, and they have a bit of a finite risk-bearing capacity. And so these models went back to the idea that these flows over here, the demand and supply of assets and the ability of the sector to intermediate, to absorb the resulting imbalances, ends up mattering for the determination of both the level and the dynamics of the exchange rate. This is sort of like one of the modern incarnation of one way to give a theoretical content to the Penticuri ideas. It's not the only way, but it's one way to do it. Now, to make things concrete, I'll review very briefly a set of equations that we put together with Xavier Gabex. If you like them, you really should think of them as being part of the work I've done with Xavier. If you don't like them, you should certainly think of it as work done with Xavier. But here's where they come from. So here's a very simple model. This balance here is what comes of the goods market. Is some model where it might have production, it might have sticky prices, but ultimately there's some imbalance that the world financial markets have to absorb that comes from trading the goods market. Here's my financiers, they absorb that imbalance, and here's the second period, there is the same similarly imbalance and the world ends, so every market clears. And really the crucial part is this part over here, is the demand equation. It's a finitely elastic demand that says that the financier will intermediate more of the capital depending on expected returns and depending on some elasticity of the demand curve. And you can derive this in many ways. When we did them with sort of limited commitment and some walk-away constraints, you can use VAR constraints, you can use other types of constraints. And the nice thing is that then you can solve this simply, and you get that the exchange rate is related to these fundamentals, what comes out of the sort of trade market, but also to financial conditions. And so you can quickly think of examples where if I set the friction is very high, the world is in financial autarky and the exchange rate has to clear the goods market period by period. So it's tightly connected to the fundamentals. Or you can think of the other opposite extreme, like the Opsol-Rogov benchmark. You make UIP hold. Finance is so relaxed that there are no risk premium. And then everything is a perfect substitute and the exchange rate is still tight to the fundamentals, but it's the present value now of the future fundamentals. And in the middle, you can see that any exchange rate between these two can be achieved for a certain level of frictions, which connects to the idea that these frictions might generate a big variation in exchange rates that is not so tied to the fundamentals, and therefore to the idea that there might be an exchange rate disconnect. And Oleg, as I will review a little bit later in the slides, has also worked on this. Now that's a first pass. The goods market is pretty small. Generally, we try to think about gross portfolio flows. Again, the idea is that where you trade in assets and how does that matter for the equilibrium. So here's a very simple example. Suppose that the Japanese wake up one day and they demand F star of dollar bonds. Just make it super simple, like noise demand. It's infinitely inelastic. They want to get hold of these bonds. They sell an equivalent amount of yen bonds, so it's completely a gross flow. And what happens in equilibrium? Well, the equation is very similar to the one before, except that the yen will appreciate on impact. Demand is high for yen bonds, for dollar bonds. I said it wrong. The dollar will appreciate on impact. Demand is high for dollar bonds. The financiers have to absorb them. In order to convince them to take the other side, prices have to move in general equilibrium and give them expected returns high enough to convince them to hold it. And you can see that this effect is completely absent in either complete market models because the agents can unwind this, or in models that assume UIP because the financiers will take the other side and just nothing would happen. So this is perhaps what these models have tried to capture. Now, of course, you can go much more general. You can make the flows much more general. You can look at return chasing, carry trade, delegated portfolios. You can go back to the idea that there are monetary shocks, and like Jean and Rose, you can link the frictions to the variance of exchange rates. You can look at infinite horizons, and I'm not going to get much into that, but there's a lot that has been done. Now, if this is the key, what is the slope? How do we measure it, and is it even there? And there again, there's been very useful work over the last 10, 15 years. There's a paper for, one set of literature went for what we call the reduced form approach. So these are inclusions and exclusions out of indexes. They create a quirky flow that is plausibly exogenous because the index provider decided to change things, but nothing has happened to the country fundamentals. There's a very nice paper by Howe, Massa, and Perez where they looked at the MSCI restating an equity index and flows that are associated with that. Recently, Pandolfin, Williams, together with Bronner and Martin, have done a series of papers using quirks in how JP Morgan weights the government bond indexes of emerging markets. It turns out that they do some very funky sort of reweighting with kinks, which really helps the econometrician. In general, this literature finds, very much like the domestic literature on stocks and index inclusion and exclusions, causal evidence that flows matter for exchange rates in the direction that we just highlighted. More recently, there's been also a structural approach, and today we'll see a paper from that. It's an approach that tries to import industrial organization supply and demand techniques and imposes more of a model structure. So compared to reduced form, it comes with more baggage in terms of a theoretical model. But then, of course, the model allows you to make more statements. For example, distinguish between short-run and long-run elasticities, elasticity within an asset class or across an asset class. There's a few more things that you can do. You can do counterfactuals. And really, Ralph and Moto Yogo have sort of started this literature. And today we'll see a great paper from Zhang, Richmond, and Zhang that will go deeper into this. Again, these are models that take a very different view of the data, but find a very meaningful role for market segmentations in explaining the joint determination of portfolios and asset prices. We're at the beginning of this literature, but you can see that the evidence is mounting, and I like a lot of the different approaches that have been taken. Now, of course, I said that portfolios are key, but I gave you a trivial example with just 2 bonds, only trades in bonds. The markets are much bigger, they're much wider. So there's been also a great amount of work on this. Elen, together with Hao and Kamano today, will present a paper on this, looking at equity flows. And now equity flows might interact with currency flows because of partial hedging. And those can also be very big. Very recently, there are 2 papers from Greenwood, Hansen, Stein, and Sundaram, and Gorinchas, Ray, and Vagianos that look at long-term and short-term bonds. So they bring in a very similar view of the world with the FX market, but they add a yield curve. And they use the Vagiano-Villa sort of segmentation model for the yield curve to sort of jointly determine a term premia and currency risk premia across horizons. There's a lot of work on infrequent trading. I mean, if these flows are important, we have to take them seriously. Philippe Baqueta and Eric Van Wickom have a series of papers, both in theory and in the data, trying to highlight how portfolios move. I'm not aware, or at least I couldn't come up fast enough with papers on commodities and real estate, but there's certainly a lot of interesting work on government intervention. Governments, as I mentioned at the very beginning, have become a very big player in these markets between QE, FX intervention, reserve accumulation. And so one interest has been, well, we talked about private flows, but what about government flows? How do they work? And here, these models have provided a bit of a different answer to the idea of foreign exchange intervention. So for quite a long time, foreign exchange intervention had a bad name in academia. I think part of the reason is people use a Modigliani Miller and sort of Ricardian logic to say that it shouldn't matter. Now, between QE and the modern interventions, we kind of realize that Modigliani Miller and Ricardian equivalents are very nice benchmarks, but they're unlikely to be what drives the data. And also, there've been large policy experiments. Here I have Israel and the Czech Republic, but Switzerland would look similar, that have gone through periods of massive FX intervention. And there's been a lot of great work trying to understand it. What are they breaking? Well, they're breaking the Modigliani Miller part. They're bringing in financial frictions so that the agents cannot simply unwind the actions of the central bank. Even if they fully understand that the central bank is taking positions on their behalf, you're not going to be able to unwind them frictionlessly. That's where this literature is coming in from. Now, how does it work? Just to fix idea, let me do a very, very simple example. Suppose that you start with the simple model we had and you add sticky prices so that we have a roll for production. And all I change is the letters. Q now is a Japanese government intervention where they buy dollars. But it works very, very similar to a private flow. What it does is it moves the exchange rates as long as there are frictions. Why? Because it's forcing the financiers like a risk transfer between a constrained financial intermediary and the government. And so it will have an impact on equilibrium prices. And in particular, it will have an obvious one. If Japan buys dollars and sells yen, it will make the yen depreciate and the dollar appreciate. How much? Well, in proportion to this. If you then add the real side of the economy, here I did an example with sticky prices, where you have output that is demand determined. So I have producer currency pricing. If Japan depreciates its currency, it gets an output boost. Okay, it doesn't have to be realistic, it's just a way to get going. Then you can get into the idea of, is this optimal, not optimal? Is this welfare enhancing? And a lot of the theoretical literature has gone deep into this, trying to think about optimal policy, which I'm not gonna try to review here. I'm gonna skip this, because as always, we're running sort of short on time. But then also this kind of literature has given us a different view of both new issues and very classic issues. One part of the literature that I really love is the cover interest rate parity literature that Wen-Xin Du and co-authors have been, and Adrian have been very heavily sort of putting forward. I think their paper is already a classic, is the first paper on my syllabus. There's been a massive break in the arbitrage conditions in international macro. You don't see that very often. And models of risk premia without frictions. So models that can generate imperfect substitutability across currencies via risk premium or no frictions are just not able to match this lack of arbitrage. So it gave us really a nice ground for models of frictions to get going. Oleg, for example, has worked on the exchange rate disconnect together with Dmitry Muchkin, showing us that if you want to get to the exchange rate disconnect and the Musa puzzle, part of what you can do is not rely only on sticky prices, but actually make the financial shocks very big and orthogonal to how the firm changed prices. That's going to move the exchange rate around a lot without moving the fundamentals a lot. So rationalizing a lot of these and giving us a different view of a classic puzzle like Musa. Again, going back to Adrian's work on the carry trade, other models can get this. It's very different from cover interest rate parity that is more tailored to frictions. But the models of segmentation have provided a view of the carry trade. They provide a very simple view. They say, look, there's a carry trade out there and capital tries to chase it, and crashes in the carry trade are nothing else at periods when the financial intermediaries get very constrained. So volatility becomes high endogenously, the carry trade crashes, and expected returns going forward are very high. That's one of the key patterns. It's by no means the only way to get it, but it's a very natural pattern in this set of models. Where are we going next? Well, I don't know. If I knew, I would be writing better papers, but I can certainly speculate. Part of what I think is sort of surprising is we know still relatively little about these portfolios. We made progress, but there's a ton that we don't know. The data is very imperfect. And I would say that recently there's been a lot of effort on this. Part of that is that after the global financial crisis, we've realized that this is a really important question: who owns the assets? And so the official sector has massively stepped up on data collection. You have the national statistics, you have central bank data, you have repository data trades on derivatives like EMIR. There's a lot of work happening there. Commercial data is also improving very fast because the hedge funds, the big investment management groups are very interested in this. So mutual funds data, insurance companies data, for example, Ralph and Moto have used, sovereign wealth fund data, all of that is becoming quite available. It's attractive to academics because it's, in some sense, is a level playing field. You buy it, you use it. It's not proprietary data of a government. So I think there's going to be a wave of work there. I'm certainly working on that. I hope to see a lot more. Let me stop here and leave you to two great papers, which I look forward to seeing presented.